joins us now. Taher, what is your sense? Now, we can't predict what will happen to levels, but what we can predict is that whether these are good levels to buy or not. So fundamentally speaking, do you think this market is now looking attractive?
So, well, I think at least a good part is that some of the factors which were creating a problem for the market have somewhat reversed, especially from a macro perspective, and especially things like currency and oil prices, which are also culprits in the recent past. We have not yet seen as much of normalcy as far as the credit markets go, is what I understand from my colleagues. And that part is still an overhang, but some of the measures which of course have been taken by the government and the RBI seem to be kind of having an effect of at least stabilizing the system as of now. So I think the markets are likely to respond and are probably responding to those, and that is one of the reasons why we believe, why I think at least we probably might decouple a little bit from the trends that we are seeing in the developed markets. So yes, there's a possibility of some bit of relief and some bit of a bounce back. I would think that as things are likely to, however, stay reasonably volatile over the next 3 months, and we are getting to a stage where, from a one-year forward basis, we may get to a lot more reasonable valuations, and that should kind of provide support to the market.
Markets will remain volatile for 3 months. Why would you say that only 3 months? I could say that ahead of elections, markets would remain volatile for next 9 months.
Sure. I mean, just that there are quite a number of important events which are lined up over the next 3 months. In particular, everything from global to local. Global, we are obviously looking forward to what's the outcome of the US elections in November, and maybe that will have some bearing, as we know, on the US-China trade conflict, followed by then our own state elections. In the meanwhile, over the next 2-3 months, we would like to see some kind of moves around the NBFC space as well, or probably the overall credit markets and liquidity situation in the system. We may probably hear a little about Brexit as well during the course of the next 2-3 months. So there are several important things which are lined up over the next few months, which make me believe that, and things could go one way or the other. Some may be good outcomes, some may be bad outcomes, and that part is probably likely to keep the market reasonably volatile. But do I expect the kind of damage that we have seen in the last say few months or the last 2 months? I don't really think so. We may bounce around a little bit, maybe a little bit of downside, but I think the next 2-3 months is when the markets will kind of settle in, post which we will take a call in terms of how the market direction is likely to pan out.
Taher, since you do believe that a large part of the fall is behind us, what is it that you have tactically done as an advice to clients in terms of their portfolio approach? Have you been a buyer all throughout this decline, or do you now believe that you will begin nibbling into the market, considering you believe that it's only a residual 3-month fall perhaps which is left?
So we as a house have been in a happy position. We've been amongst the flows in the market, and that's kind of allowed us that additional flexibility in order to buy into names that we like, into some of the spaces that have corrected meaningfully, and where we can kind of we feel reasonably protected even from a downside perspective in all kinds of sectors, be it NBFCs or be it even banks, or probably more technology or whatever else. So to that extent, we have used this opportunity to buy. We have become a little more constructive on the mid and small cap space. We think valuations have corrected very meaningfully out there. They are not cheap, but they are still a lot more reasonable than what they were a year ago or maybe 18 months ago. So I think we are turning constructive on that space. We are trying to nibble into opportunities. Some of our own existing ideas have, of course, taken a beating. We have taken the blow on the chin, but they themselves are looking a lot more attractive now. So we are happy to even buy into some of those names. So I think that's how we played it out. We've tried to put money to good use and try to make sure that we ring-fence the portfolios at the same time.
Of interest to you, where is it that you find buying opportunities, or have found buying opportunities in the last few months?
So we've done a bit in the banking space, especially the corporate banks. We've nibbled a little bit into some of the NBFCs, which have also seen a lot of correction. I think technology and particularly large cap and maybe even mid cap tech is probably now turning a lot more reasonable in terms of valuations once again. So we've seen almost a 15 to 20% correction in many of the names out there. This is something which excites us. We've nibbled a little bit even into the oil and gas space, particularly the gas side of the business, gas side of the equation. So that's these are some of the things which I can recollect where we have incrementally put our money to work.
Okay. What is your call on corporate lenders right now? There's a big story in the markets about how finally things may be turning around for ICICI Bank and Axis Bank. Now their leadership transition is a thing of the past, and they've done enough and more perhaps to clean up their books.
So if you recollect that we did position ourselves, especially from the perspective of our value strategies, both on the mutual fund side as well as on the PMS side, in the corporate lenders almost a year ago, and we're kind of riding that position right now. We've seen a lot of ups and downs and a lot of bumps along the way, which was expected in a way to happen. I think gradually we are seeing some of the clouds clear, and that's a happy situation to be in. I think we would like to believe that there is a decent amount of steam which is still left in some of these plays. Things are starting to normalize. Credit environment in terms of growth is getting a little better. Plus the fact that on the asset quality front, more importantly, I think trends are returning a little more closer to normal of what it was 3 to 4 years ago. And I think some of these stocks at those stage at that time probably traded at a lot more higher valuations. So would like to believe that there is a certain amount of valuation catch up which is still possible between them and some of the more expensive private sector banks, which have generally been reasonably a lot more premium in terms of valuations. So I think that gap can kind of narrow a little bit more, and we have growth to support as well. So I believe that space still has a decent amount of upside left.
What do you make of this sudden drop in consumption? The data which we've got from car companies for Diwali, pre-Diwali and post-Dussehra is not very encouraging. Do you think now an uptick in interest rates will start biting consumption? It may not bite short duration borrowers, but for car borrowers, for home borrowers, those who are borrowing for 5 to 10 years, those borrowers will take it easy, and it could dampen demand for autos and housing further.
I would like to believe that things will take a little bit of time to stabilize on the consumption front, and especially both in autos as well as in mortgages. Busy season is, we all know, is not probably worked out as well for some of these companies, largely revolving around sentiments on the ground and some of the macro issues, and then finally burdened with some of the NBFC related challenges. I think this situation will perhaps last for a little more time, maybe the next 2-3 months, because post the Diwali season we don't really have typically sales tend to mellow down even further up until the beginning of next year, when models roll over and so on, the year rolls over and so on. So to that extent, I would think the earliest that we will probably start seeing improving trends in autos and consumer discretionary at large will probably be early part of next year. Up until then, I would like to believe that stocks have of course corrected. Valuations are somewhat cheap, not still absolutely in the attractive zone. But we can probably see them stabilize a bit at these levels, and then take a fresh call as demand environment stabilizes. So I think for now we are happy to be in whatever we have. I'm not sure if it is we are significantly inclined to immediately increase our positions or our exposures in this segment.
Mentioned that you are finding opportunities within small and mid caps as well. Highlight for us, are there any concentrated bets, or again it's a very stock specific approach that you're following there too?
It's pretty distributed. I mean, there are, I can't even call out any particular sector as such. So it's all over the place. There are things in let's say the oil and gas space. There are things in some of the consumption related areas also. So I know that the sector, that side of it will probably remain a challenge, as I said, but like the valuations in some of these have really come off very meaningfully. So if we are taking a 2-year out kind of call, we're happy to bite into some of those names at this stage. Consumption, oil and gas, I would think a little bit of even some in the pharma space, some in financials as well. So it's a combination of all of these, which is kind of attracting us. So it's a completely bottom-up constructed portfolio. I don't even right now have the contours around our and particularly we've just, as you know, we have just closed our small cap NFO. So we're trying to build that out, and we would like to believe that the opportunities are very attractive at this stage.
Okay, Taher, great to have you on the show. Thanks so much for taking the time out and joining in today. Let's take it across to my colleague Jayesh. Now, remember the Nifty is expected, PE for FY19 is corrected over 13% from the life highs on the 28th of August 2018, and now quotes at just over 17 times. So which are the sectors that have seen high and significant contraction in valuation, and what's the expectation now going forward? Jayesh has been culling out that data, and he joins in with all the